Good afternoon, everyone. Welcome to Short Verticals. I'm Brett Crowther. Good to be with you back on another Thursday. We're going to discuss really an important thing that I've seen in like 20 years of teaching. I've seen a lot of confusion around this topic that I want to cover today. A lot of misconceptions about short verticals, like a short put vertical against a long call vertical. Are they different? Are they the same? If they are the same, what are the similarities? If they're different, what are the differences? It's important to know this because, and again, this is something I've seen people not understand in years and years and years of teaching this material. So we'll get into that. We're going to look at the market. Well, we'll get into a lot of things, but first off, welcome everyone. Good to have you, Will, Ricebird, Richard Judge, Robert. Hey, welcome everyone. Good to have you with me this Thursday afternoon. So do follow me on X, Brett Crowther CS. Give me a follow over there. I'll post up-to-date information that you can check out on X. And it's always good just to have that ability to talk to you in between, every Thursday, right? And we're going to go into a period here where we're not going to have class. I mean, we'll have it today and next week. And then after that, actually it'll be class, but I'll be gone on a vacation with my family. And then we have Christmas a Thursday after that, and then New Year's a Thursday after that. And so we're going to go for a little bit of a drought here. So it'll still be nice to have a way to communicate with you. But as we get into today's session, let's cover the disclosures first. So do you remember, well, come on, boy, haired trigger there. Do remember that options do carry a high level of risk, not suitable for all investors. The information here is for general informational purposes only, not considered a recommendation of any sort. We do use technical analysis. It's not the sole means of investment. The use of paper money is for educational, illustrative purposes only. Do understand that short options, and we're going to be talking about those today, can be assigned at any time, regardless of whether they're in or out of the money. And past performance does not guarantee future results. Also, there's your option Greeks, delta, gamma, vega, theta. Do understand they're just probabilities when we're talking about the delta. Exact science there, but just a general idea. And then the stop losses does not guarantee to activate, or any stop type order will not activate, is not guaranteed to activate at that price. Okay. So with that covered, let's jump out to the market here. Let's take a look at what's going on in the overall market. I think this is interesting because let's do some technical analysis, kind of set the stage here. And I don't want to spend a ton of time on it, but I do want to spend some time to kind of get the lay of the land, right? And why is that not wanting to pop up here? There we go, SPX. Okay, so we got the SPX up here, and it's been on a pretty good run, but we've seen a pullback, since, what is that, Halloween? So usually it gets scary going into Halloween. Well, this year it's been scary coming out of Halloween, right? That's where the market has taken a little bit of a dip since that point. Now, it did drop down till just before Thanksgiving, November 20th or so, and then it's been rallying since then. Okay, so where does that leave us? Well, after we've had this overall big run where we've run up and pulled back and run up and pulled back, the overall trend was upward trending, right? Now, does this change the trend? Well, this is where it gets a little bit tricky, and some people say, what is the moving average doing? Some will look at lower highs and lower lows, or higher highs and higher lows. I mean, technically, maybe you got a little bit low in here, but generally speaking, the lows, still kind of came down to the major lows. And I try to look at the big movements, not just like little hiccups that I have here and there. But, we got a little bit of a 2-day up right there, but then it was right back down, right? And so I look at these as the lows. And so we're seeing similar to equal lows, but bouncing back up. But this is interesting because as we rally up higher, it's not really making a new high, getting a little bit of some kind of doji type candlestick formations up here, a lot of smaller bodied candles. And so it doesn't show a lot of momentum, coming into like this week, really, right? And this is kind of an interesting week. We do have earnings, well, not earnings announcements. What am I saying? We're kind of out of earnings, but just looking at some of the economic data that we have had this week, the manufacturing data was on the weak side. And so there's contraction in manufacturing. Yesterday was the ADP report. The ADP report said there was a loss of 32,000 jobs versus a gain of 5,000 jobs. Now, I want to just state something about the ADP report. I've been watching this report for many, many years, and it can be off by as much as like 100,000. And so, take that with a grain of salt. The unemployment claims came in today, and they came in at 191,000. which was lower than expectation of 219,000. So, you kind of have a mixed result, but really a lot of the news that we're going to be keeping an eye on that can possibly shake up the market is going to come out tomorrow with the core PCE, the one that the Fed usually likes to look at for inflation information. We also have consumer sentiment and consumer expectations. And so there's some kind of heavy hitters coming out tomorrow. So we'll have to see how things can change up tomorrow as that news comes out. And again, the news is kind of funny too, because we've gone through this period where we got 2 months worth of just a black hole of data. And now we're starting to get some data kind of catching up and filling us in on, what was the results of the downtime when we had the government shutdown. So, there'll be some interesting things coming down the pipe, I'm sure, as information starts to flow like normal, right? And typically speaking, we have the unemployment report on the first Friday of the month. But this time it's on the 11th. It's next Thursday. So that one's going to be delayed just a little bit, but we'll look for that. Okay, so now some people are saying, hey, it's right for another pullback or so. So let's talk about that. So, if we look at the MACD, and this is, one of the indicators I tend to look at, and, nothing's perfect. And really the indicator is kind of in the eye of the beholder, meaning a lot of it is simply interpreting the same information in a little different way, and we tend to figure out a way that identifies with us, right? The way we see things, the way we interpret things, it just kind of resonates with us. And so everyone has to find out which indicators kind of resonate with them. For the MACD is one that I have on my screen, and I look at the MACD, and the MACD is starting to roll over, showing us a little bit of weakness here as this kind of drops down. Now, one thing, there's another indicator I'll throw on from time to time, which is the RSI. And let's go ahead and throw that on. So Relative Strength Index, I'm just going to type in RSI in here, and it's right there. So click on that. We're going to add that to our selected and hit apply. And, this one's kind of interesting. It's going to give us a little bit different take. Well, maybe not completely different, along the same lines, but this one is showing a little bit more bullishness on the MACD rolling over. And this is actually the histogram that I'm looking at. It should probably be clear on that. But if we look at the RSI, in fact, look at this. I already have a line on there, kind of showing us some downward trend line, kind of catching the peaks of this, showing that it's got the momentum isn't quite there. Every time it's rallying to a lower high. And so it's indicating some weakness in the overall bullish rally that was going on, right? And so that would indicate, without the strength, down below, that this could potentially roll back over and maybe come back down to level support or something. It just means that there's not a lot of bullish emphasis going into this. It's waning as it climbs. Now, let me show you one other thing, just to almost throw another wrench in the whole story, right? Let me add in the MACD 2 lines. This is actually the MACD itself. The histogram is simply the difference between the 2 lines. And so I'm going to add the 2 lines. I'm going to leave it at 1226.9. It's a little longer application of this, but I'm going to add that to what we have. I'm going to get a lot of things on here. In fact, maybe I'm going to take off that RSI. We've already talked about that, so we'll remove that and just apply the 2 lines. And do I have 2 of them on there? Oh, I do. Let's remove one. And here we go. Now we're good. Okay, so now we look at the 2 lines, and what this attempts to do is illustrate longer term momentum, right? Like, this is kind of short term bullish momentum and bearish momentum. This is longer term. When these 2 lines are above that 0 line, that's overall bullishness, right? Now look at this. It had a dip here, and so it's been above there for quite a while, since May, and then it did take a dip below the 2 lines. This is the signal one, the blue line, that dipped below the 0 line, but it's back above the 0 line. And so this would say longer term bullish momentum was there. It dipped down. It's kind of had a pause, but it's back above. And so what this is indicating, according to MACD, is it's back to longer term bullish momentum, and yet we're talking about this potential pullback. And so what it can be is a potential pullback in a longer term uptrend. And so, according to the indicators, it wouldn't be surprising to see it pull back a little bit and then possibly, find a support spot and rally. But let's see, if that is what indeed comes to fruition as time goes on. All right, but so that's kind of the lay of the land as we got it, right? Now, a couple things I want to talk about in here. Oh, you know what? We got to talk about our past trades, right? Because some things have happened since last time we talked. We had an RTX trade, and unfortunately, both of them kind of went south on us. So if you recall on this one, we saw this gap up on the earnings. It went up, it came down, it kind of tested a support level, and this is where it was when we entered the trade. Now, I mentioned that day that, it's not ideal kind of get on a bearish day. We'd like to see that bounce and head back up. But, I can only teach the class on Thursday. Didn't have the luxury of waiting for, another day or two to say, okay, here, let's go ahead and, enter the trade on Monday or Tuesday or whatever else, right? And so it did come back down. And let me just give a little bit more space. In fact, I apologize. Let me remove some of this so we have a little bit more space to look at our price action. So we're done with the two lines. We're going to remove that, apply that. There we go. There we go. Now we can have a little bit more space in here, right? That's what we need, is some space. So when it came down, we wanted to get in on a bounce, but it wasn't really bouncing. We still entered the trade, but it did kind of crash through. And then I didn't catch it that day, but when it came down and broke through it again, I caught it there. So, we entered the position at 210. I removed it at 250, so we lost 40 cents per contract on 3 contracts. This was about $120 there. So the bullish one went south, and then we had target, and this is the bearish one went north. So, kicking the pants on that one, right? And this is a long-term support level that it broke through, and that honestly was from a technical standpoint was a good signal, And this is what kind of can drive traders crazy, is they see something like that and they say, gosh, that was a good signal. What's wrong with me? What am I doing wrong? And it's not. It's a good signal, and other times that one could potentially work out a lot better, right? But this is the whole reason that we use position sizing. We don't put all the money on the position, right? Even if it looks like it's a fantastic opportunity, it doesn't matter. You don't know if it's going to be the winner or not. You line up, the technicals and anything else that you're bringing into your analysis, and we look at that and say, okay, this is what's giving us the indication that it has a propensity, the tendency to continue in a direction, and that's what we go off, right? But just in case we're wrong, we're going to do some position sizing. Well, anyhow, that one bounced back up, and so let's see, was it target? I think it was target. No, it was RT. Yeah, and so I bought it back. Bought it back a few days later when that broke back up, and so that's what happened to those two. So that's sometimes you win, sometimes you lose, but we keep track. I'll keep track of them and show you how they play out. We've had a lot of big winners before this, and then we had a couple losers, and it's really I probably ought to stress, this is the psychology of trading. Anyone who's been around enough knows that it's difficult to kind of take some of those losers in stride, right? Because you really start questioning yourself and wondering, what's going on at times. But understand that, what? You're going to have winners and you're going to have losers. And I would often kind of, if I could use a bad analogy, but it's kind of like playing baseball. You don't get a hit every time at bat. Good players are 300, 400. But, it's all about how it plays out. And as long as, in the end, it's making more money than you're losing, it's coming out ahead, right? But we can't look at it as every single trade needs to be a winner. And so very, very important psychological aspect of the game. All right. Now, what I want to do, though, is I want to look at, in fact, let me bring up a chart. Let's go Coca-Cola. Coca-Cola, KO. Now, Coca-Cola was looking a little bit better this morning. It's starting to pull back a little bit. But something like this, maybe there's some support. You can see somewhere like the moving average is doing a pretty good job, maybe on some diagonal support, something like this. So there's a possibility of some support. Now, let's be clear. It has not bounced. It's not looking like it's bouncing yet, right? But I want to use this because Coca-Cola has some nice tight bid-ask spreads, and I want to use this as a way to talk about the difference between like a long call spread and a short put spread, or the difference between a short call spread and a long put spread. If we can keep those two categorized, right? Because I hear people say stuff like, well, you want to do, your credit spreads out of the money, you want to do your debit spreads in the money and stuff like that. And, I hear all these things. I'm just like, I don't understand exactly where they're coming from. And so I want to take some time and just go through it. All right. So let's do this. And I hope this teaches you something that you didn't know before about these types of trades. And so let me make sure, I think I got us all clear, but let's just make sure it's clear. Yeah, we're looking good. Okay. So what we're going to talk about is a bull call, or let's do it this way. It's one name for it, but a more proper name is long call vertical, right? And on that long call vertical, we're going to look for the max gain I'm gonna look for the max loss that we're going to create here. And we'll look at the break-even points. Okay. And then we're going to do the same thing with a short, see, on call vertical, short, put vertical. And on those, we're going to do the same vertical. We're going to do the same thing. Can I copy and paste and we'll be in business? Yep, there we go. So we're going to look in, we're going to compare and contrast these two trades, right? I'm going to create the same trade on both sides. And so let's start with the long call vertical. I have Coca-Cola up here. I'm just going to use the December expirations just as an example. And I'm going to look at the, where are we at? 70.65. We're going to go, no, kind of changed on me since I was preparing this, but let's try a 69.71. So what we're going to do is we're going to buy the 69 strike, and then we're going to sell the 71 strike. Okay, so let's create this. So let's go ahead, grab the 69. We're going to click on the ask and buy that one. This is our long call. I'm going to hold down the control key. I'm going to come over to the 71. I'm going to hit on the sell, and we got what, $1.35 debit on that, right? So what does that do for this trade? Let's get another space in here just so we can see this. Okay, well, an easy way to kind of figure out our max gain, max loss and all is really hit the confirm and send and pull it up that way. And so this says, what can we make on this? We can make on one contract, we'll just keep it simple here, we can make $65, right? And then what's the loss? Max loss is 135 and the break even is 70.35. So let's get this. The break even was 70.35, right? That over there. Max gain was 65 cents, if I wasn't mistaken, right? And the max loss was $1.35, basically what we paid for it. Maybe put a dollar sign in there, just so we have it on all of them. Okay. Everyone good with me so far? We all good with this type of trade? Let's see. I got a comment in here saying, I don't understand why you decided to go bullish on KO. I'm not. I'm using it as an example because it has very tight bid-ask spreads that I want to use to illustrate the difference between, or the similarities between a long call vertical and a short put vertical. But yeah, we're not saying let's go with Coca-Cola as an example trade in this situation, okay? All right, we're good. Good. Now I'm just going to put this in the Analyze tab. And actually, we could do some analysis. I did a lesson on this, last week, I believe it was, where I talked about the Analyze tab and just, how it functions, how we can look at this and say, okay, here's max loss. A max loss comes in here around $69 and up here is max gain above 71. We don't make anymore. So that's, really kind of the idea behind this trade. We want it above $71 to make max gain, right? Once it's above $70 for max gain. So that's kind of the goal of that trade. And then it gives us the probabilities, and we can move this around. We can say, okay, where's the break even at expiration? What's it? That's 70.35 is where that is, and it gives us the probabilities of that. We're talking about a 50%, 53% probability that it'd be above that by expiration, according to the Thinkorswim tools, and 47, we'll say, percent that it'd be below that, right? And then what else? What about the ability to be at max gain? Well, the max gain is about 44%. With the way we have it set up. And then this area in here is kind of the range, the expected range that the stock should fluctuate between. Coca-Cola is not a big mover, right? But it should fluctuate between about $68 and maybe $73.50 as we work our way into expiration. How did you get there from the trade setup? Good question. Is I simply, from the trade tab, I just right-clicked on it, down here on our order, I right-clicked and I went to Analyze Trade right there. And we're going to do it again. So we got that one in there. Now, let's delete this. In fact, let's create this again. But this time, let's create a short put vertical. And we're going to do the same situation. So we're going to create the same trade. Because so many times when I see people talk about comparing a long call vertical and a short put vertical, they select different strike prices and stuff. And if you select different strike prices, yeah, it is a different scenario, right? But if you take the same strategy or the different strategies and select the same strikes, the question is, how does that play out? Okay, so let's do this. We're going to go ahead and we're going to buy the 69, right? And we're going to sell the 71. And it's moving around a little bit, but this will make it match the other one. But here's what we got. Here's what we got. Is we're going to get 65 cents on that trade. The way I have this set up, and so and we have a little bit of difference here between the mid and the natural and stuff. And the tighter you get those spreads, the more this will be like almost exact. But watch this. I'm going to go ahead and hit confirm and send. And we're going to look at the break even, the max loss, the max gain. And what do we have? Well, what is the max gain on this? $65. What's the max loss? $135. And what's the break even? $70.35. So let's get that down. So the max gain is 65 cents. Or maybe I should look at it in dollars, but it still works out. 0.65, right? Whoops. 0.65. Boy, missing the fives and whatever else. Okay, max loss is 135, and break even 70.35. Okay, anyone seeing something similar here? Anyone? Let's put a line in between here so we can see where our two trades are. It's a long call, And also, let me put down here, we're going to buy just the same way. We're going to buy the 69, and we're going to sell the 71. So, long call vertical with the 69.71, we got 65-cent gain. Short put with the same strikes, we got a 65-cent gain. Same setup, we got a max loss of $1.35, max loss of $1.35. Break even, 70.35, break even, 70.35. Where does it need to be for us to make max gain on the short put vertical? Do we know? Right, just figure it out, right? It's pretty simple at this point. To be above 71 for max gain, same thing. Let's do this. Let me go ahead and right click on this. Going to come down to analyze trade. I'm going to put this one in there. So now we have both trades in there. And so you can check and uncheck this to see which one it's focusing on. And so again, here we are looking at simply the long call vertical. And again, 44% probability of being hitting max gain. We look at the put side. Get this right there. What are we at? It's right around here. About 44% probability. Why? It's the same numbers. Is everyone seeing this? It's the same numbers. Yeah, Chris, you got it. Yeah, above 71 for the max gain on the short put vertical. So this comes down to the question of which one's better. And I hear that all the time. This one's better, that one's better, whatever. It's the same thing. The stock has the same range that it's likely to go between, because there's only so much volatility it has until expiration. And so that's the same. In this case, it comes down to it is the same. Now, depending on let's talk about some differences, right? Because it's not always exactly the same. But what I want you to understand is the concept, the construct is really the same. When you're picking a 69.71 and you're bullish on that, whether you create it with, two puts or you create that with two calls, the way we've shown here is it is the same setup, right? And the numbers pretty much work out the same. Now, from time to time, depending on the bid-ask spread, some can widen one further on one than the other, and so one might become more advantageous than the other. And what about the difference in this? Well, as one goes into expiration, typically speaking, generally as a general rule of thumb, we don't want to let them either one of them expire, right? But technically, if they go into expiration as above 71, then on the call vertical, right? It buys it at the 69, sells at 71 to obligate the assignment that would happen, and we'd make the $2 minus $1.35, or get our 65-cent credit. And in a similar fashion, on the long put or the short put vertical, it would just basically expire worthless because both of them would be out of the money. So someone would say, well, you got more transactions on the long call vertical than the short put, which, that can play a role in it too. But so there are little differences that way, right? There are some nuances in that sense. But generally speaking, it's the same thing. It is the same thing. I really want to stress this because I have just, for decades, I've listened to people talk about this, about how, if you want to, be more bullish, then go with a long vertical. If you want to be more bearish, I'm just like, what in the world? It really doesn't matter. It's where you set it up. Like, how could we be more bullish on these trades? Well, if we're more bullish, we'd set it higher. We'd set it, instead of 69.70, if we want to be more bullish on this, then we'd set it at something like, maybe a 71.73, kind of keeping with the two wide strike, right? And we could do that on both of those, and it'd be the same thing. Or if we're less bullish, we could go a little lower. You see what I'm saying there? It's 69. Did I get that right? Which one's selling? I want to sell 73. I want to buy this 71. Unlock those. There we go. But it becomes the same trade. Back and forth we go. But now we just shifted it all up. So now the price has to be higher for us to make max gain. So now in essence, we'd be more bullish. We'd have a more bullish outlook, and also our numbers would change, which the probabilities drop down. So the probabilities are like 16% of it being above that strike. In this case is 73 at expiration. And so with less probability, there's going to be a higher return on that, right? And so on this one, we're going to get a $1.22 return versus the 65 cents. That'd be the same thing here, meaning this one, if it expires above 73, we'd collect the $2 minus the 58 cents, which would give us what, $1.42 or something in there. Is that right? Yeah, I think so. So again, you can get this is where you get some differences in the bid-ask spread. So any questions on that? I just want to make sure that we're all on the same page on that, because this is such an important thing. Let's see. Long call vertical requires rapid movement in the stock price, whereas the short put vertical benefits from the time decay or MOA off. No, actually, they're the same. If we go over if we go over as you construct it, now remember, one is going to have a positive, and the one's going to be a negative, but the Greeks are essentially going to be the same. I'd like to show you on this, but I'd have to go to like an ETF, which I think I can't do here. To get a really tight bid-ask spread and show you the Greeks essentially being the same. Of course, what I'm saying here is on the long side, you might have a positive, 30 delta, where on the short side, it's a negative 30 delta. You see what I'm saying? But it's like the same. It's just one's positive, one's negative, but it's the same. Let's see what else we have in here. Selling the in-the-money put adds a little more emotional risk, but yeah, okay, that's fair. Saying that the Analyze tab has a 56% probability to show lower look, like shows to be lower. Looks like confirmation of it being bearish. Yes, no, it does. It's not showing that. It's just where we selected the strike prices is really all it is. We select a higher strike, it's going to show lower probabilities, right? Select a lower strike, it's going to show higher probabilities. It's just how far away from the at the money you are changes those probabilities. So which line would tell us the profit or loss? So we lost, let's say, by tomorrow. Okay. So this question, there's a question that came up about, okay, which one is it? So right here, the blue one is actually the profit loss at expiration. The purple one is today. And so you can crank this up here where it has this right here, this calendar. If you crank this up, actually, no, I'm coming down here. Sorry. I think it's this one. That one? Yep. This one right here is showing today's date, right? But if I move this towards expiration, if I get closer, this will show you. And notice, so let's say like this is the 9th. What is that, next Tuesday or something? I want to say it's Tuesday off the top of my head. But you can see how this purple line is morphing into the blue one. And you notice also how the gray area is shrinking. Why? Because there's fewer days till expiration. So based upon the volatility that is expected, there's less room for it to move, right? Expected move. We should always throw it in there. It's expected move. If something came up and said, someone released the secret ingredients for Coca-Cola. Of course, this could go volatile and go haywire. But all things considered, just normal activity, this is what would be anticipated. And so you can see how that molds in, the purple line molds into the blue line. So at expiration, it is one spot, right? Now we're at expiration. On the 20th, it expired. So hopefully that answers that question, though. It is the purple line is today. And if you want to see tomorrow, well, take it to tomorrow, take it to the next day. And you can see what it would look like then. And notice how the probabilities, it changes, right? Like what's the likelihood of it being above 97 as we go forward? Well, with the stock price currently down here, it's less, right? Because there's less time for it to get up there. When there's more time, there's more opportunity. Let's see, boy, lots of questions in here. How do you know which one would be right to pick? Long call vertical, short put vertical. And that's the point, is there's not a right or wrong. You can do either one, right? Some people like the idea of taking the credit that comes in with a short put vertical, and then if it goes way up, just letting it expire worthless, and so they like that. But is it, and this is what I really want to stress, is it different from doing a long call vertical with the same strikes? As long as you can get the same same risk reward on that, I mean, you got the same, max gain, max loss, there isn't a difference. Except for, you probably want to close this out at expiration. But a lot of times you want to close out the short ones too, the short put vertical at expiration. So, the question is, like, if it goes way beyond, and we talked about this last time, if our short vertical is well out of the money, right? You're just like, okay, it's not coming back. Then that can be a little bit of a benefit over the long call vertical, where it would then be exercised if you let it go into expiration, and then it'd be signed and exercised. There's two legs, but then the idea would be it'd be pulled through. But there's also things where it doesn't always pull through, right? Meaning there are times where one leg could be activated and the other one isn't, and that's why we also want to stress, the fact that nothing's set in stone, right? So just be mindful of that on any of these trades. That's why if you really want to be in control of the trade, we want to close it out ourselves before expiration, not go into, and just think, well, it should, yes, but does it always? No. So let's be clear on that. Let me just see. Long call vertical always confuses me as to when to give up. Well, this is an interesting one. Okay, let me say this again. There's a question about the long call vertical always confuses me of when to give up. But if we're looking at this, if we're looking at the chart, we needed above, in our first case, what was it? The 71. It's the same thing, right? We need it above this level at expiration. And so if it were to fall down, and if it would be the same spot where we'd want to get out of the short put vertical, well, that would be the same sign to get out of the long call vertical, because it's the same setup. You see what I'm saying? That's really what I want to stress here is the technical aspect of it. I mean, that's all the same. It's all the same. Let's see, on a vertical, the purple line is showing what you paid as break even. Yeah, it does. The purple line will indicate, generally speaking, like what we paid. So let me go back to this. Like, let me grab this one and let me reset this. What is today, the 4th? So the purple line, if you take that to break even, notice this, where is it, right? Let me just round this out to make it easier. 60 cents, it's easier than doing like that 58. And so what we did here is a debit of 60 cents, right? On a 71.73, right? So where is that break even? Well, notice it's the 71 minus, do I have that right on this one? I do have just that one. The break even on that should be, let me reset this. Do we have everything? I think I have something else going on here. It's really, I'm sorry, that is as it is today. At expiration, the break even is going to be at 71.60 because we paid 60 cents for it. But yeah, that'll show you where the break even would be today. There's 70.63 is where it is today. And as it gets closer to expiration, you'll need that to go up until at expiration it's right there at 71.60. I don't have it dead on, but hopefully that answers that question. Okay, all right. Now, maybe we can, so, do this. As we post this class, if you have questions that continue on this, post them in the comments on the class, and I'll go back and look at them, and we'll address other ones in future classes on this topic, okay? Which, by the way, I do want to show that, when you're out there, take a look at not only this class, but take a look at the shorts, because these YouTube shorts are out there. I've created most all of these. Most all of these are me. And, there'll be one, like I want to show you this one here in a second, where we look at, like, this is talking about some price patterns. And this one I did a price pattern on Tesla, right? Tesla entering into a symmetrical triangle that then broke out. And then later on, I did a follow-up on it. So here's Tesla like a week or two later, and what happened with it. And then I think I did one just, there it is right there, kind of giving an additional follow-up of, okay, well, what happened with it? And so I talk about different things that are happening in the market, different ways to look at it. I talk about different technical indicators, and these are quick. These are under 3 minutes, and so you can go out there and just get a quick understanding of something. So take a look at those YouTube shorts. In fact, I'll put a link in the description, but it's really simple. It's from our Trader Talk page. Just go on the shorts right there, and that's where you'll find those. But real quick and easy to give you a lot of information. It's also something I can throw, I'll put up in between our classes too. I try to do at least one a week. Let's go to the charts though. And in fact, let's look at that, because I was looking at NEM earlier, because NEM was looking kind of similar to Tesla, how it was. Because look at this, you got this supports that are getting higher and resistance that are getting lower, right? So it's kind of making that symmetrical triangle very similar to that one I was pointing out on those YouTube shorts right here with Tesla, where it was winding up, looking to pop out. It did break out. It actually did a retest of the breakout spot, and then it made its run, and it was, you look at the width of the channel or the pattern to kind of get a gauge of the potential target area, and that's, where it gave us a target somewhere up in here. So let's go back to NEM. So looking for this one to break out. So this might be a homework assignment, is to just watch this even as a price pattern to see if this one breaks out and which direction it does break out. Now, typically speaking, the idea behind a symmetrical triangle is it's a consolidation in the trend. And so it should break out in the direction of the trend. And so in this case, the prior trend being bullish, let's edit this and make it a different color so we can see it being bullish. We're going to look for that to break to the bullish side. Doesn't mean it has to. Let's understand that, right? But we'll duplicate that. But if it does, wherever it breaks out, we'll have to see where that breaks out. But assuming it breaks out, let's just say in a couple days, then this is what we'd be looking at as a potential target up around this 113. And then if it breaks the downside, we can look at that as well, and just subtract that. But that's the idea behind the breakout. So we'll have to keep an eye on that. And, we see the same pattern here on our indicators where they're winding up as well. And stocks don't tend to like to be wound up. They need room to breathe. They want to run. They don't want to be corralled. And so they don't like to be pent up, and they'll pop often when they do break out of these triangles. So we'll keep an eye on that one. But let's also look at Home Depot. Let's see how Home Depot's coming along. And just do some technical analysis earlier. Okay, so now this one, a little different story. This one is in a downtrend, and it's looking like it's coming back up and bouncing off resistance. In fact, sometimes I'll throw a fib on there. We don't have a ton of time. I need to spend some time going over just some Fibonacci's in this class sometime. But look at this. If we come in here, throw some fibs on there, looks like it came back to a 50% retracement on that downward move that it had right here, right back up and potentially rolling over. And so let's use this as our example today. As a paper trade, as an example trade. So let's see if we can make anything happen with Home Depot. And it looks like we got some resistance somewhere up in this. Whoops, let me grab a different tool here. We're gonna see this. Where is this? About 360-ish. So let's see if we can construct something around that 360. So we'll go to the trade tab. We got Home Depot up here. And December is getting a little tight. We may have to go out to January, then maybe 43 days to really get enough juice to make this worth it. And I don't know, we'll have to see. But if we're going to do a bear call spread and we want to be under 360, let's try selling the 360, and then we'll buy the 365 and see what that looks like, if that's going to give us what we need here. And so on a 5-wide spread, that gives us, it depends on if we can get this filled or not, right? Because that's going to be, in paper money it does, in live money it maybe isn't as sweet, right? But we could do, if we can get $2 out of that. And sometimes, we can place them and just let them sit there and see if they get picked up. And if so, great. If not, then that's okay too. We didn't miss a trade. It just never really materialized. But we do this, we can do the max profit here is $300. Max loss is $200. And what's the probability that we're looking at? So we got it's about a 40% probability of it being in the money based upon kind of the general. I mean, it's not, I shouldn't say it's a 40% probability with the delta because it's just a general guideline, right? But just somewhere around, it's an approximation of roughly 40% probability of being in the money, roughly 60% out of the money. Yeah, let's run with that. Let's run with that. A little bit on the high side, but we have some time to expiration. What was our risk on this? Our risk was $200, so we could do 5 contracts if we do $1,000, right, of risk. $1,000 divided by 200 would be 5. So we'll change this to 5. Oh wait, I set that up wrong. Hold on, I'm doing the calls. No wonder it's looking funny. Oh no, that was right. No, we're doing the bear calls. I was thinking else on put. Let me grab that again. So we're gonna sell this one, buy that one. There we go. I was still getting it wrong because I was like, it's not supposed to be green. So I'm glad I caught that. Let's bring this down. This is going to be, I'm going to bring this down to make it a little bit more normal. 25. Okay. So here's our deal on this one. So same thing. We're going to be below 360 at expiration. We're going to look for a $1.85 credit. That's going to give us about 315 on our max loss. So in this case, I can only do 2 contracts. I was thinking that other one was a little rich. But so we'll only do 2 contracts on this to make that happen. But all those probabilities we talked about before are still the same. So let's make it 2 on that. And I'm going to go ahead and confirm and send that one off. And I'll put that one, I'll write it up on the chart. And really what we're looking for it to be is below 360 at expiration. So we're looking at somewhere, mid-January. We'll have to keep an eye on that. But we'll talk about that one next week. And again, make sure you put in, your thoughts on, this whole vertical versus vertical, like a long call versus a short put, right? And it's the same thing, whether it's a short call and a long put, the same strikes. It tends to be very similar as a trade. But if you still have questions on that, please put that in there. Let me know, what is still kind of those questions hanging out there, what you need help on, and we'll address them in a future class. Meanwhile, we'll look at this Home Depot trade next class. We'll follow up on that. And we'll also see what else the market has. And then, I talked about some homework, the Newmont mining. One other one that I was looking at, let's see what happens with this one, that we can use this as a homework to keep an eye on, is this one, Uber had broken through support. Check this out, big breakthrough support, rallied back up, right back at resistance. Now, it has not rolled yet, right? But, old support, new resistance is the concept. I'll keep an eye on this, see if this rolls. And then, maybe I'll even place a paper trade on that in the meantime, if it does, in between our next class or in between next time after that, if it hasn't rolled by next week. But we'll see. But that is it for today. So thank you very much for joining me. We covered a lot of information and hopefully dispelled some myths that, I can't run to constantly. So hopefully you're the smarter group now. You're on top of it. And if not, let me know what I can help you out with. But again, thank you so much for joining me. And I'll look forward to being with you again next Thursday. Take care.